Ladies and gentlemen, thank you for standing by, and welcome to the Kelly Services Fourth Quarter 2019 conference call. At this time, all lines are in a listen-only mode. Later, we will conduct a question-and-answer session. Instructions will be given to you at that time. If you need assistance during the call today, you may press star and then 0, and an operator will assist you offline. And as a reminder, today's conference call is being recorded. I would now like to turn the conference over to Mr. Peter Quigley. Please.
Thank you, Cynthia, as well as some commentary from me as Kelly's new CEO regarding our current and future states. How we'll approach this is that I'm going to share some Q4 headlines, then Olivier will walk us through Kelly's quarterly and full-year performance and provide some details on our balance sheet and cash flow. I'll then share some of the significant actions we've taken in my first 120 days to address near-term priorities, primarily on growth. Olivier will follow up with our short-term financial outlook, and finally I'll turn to what's next, including longer-term initiatives that position Kelly for its future, including bold plans to accelerate our organic and, importantly, our inorganic growth through M&A. These plans, some of which depart from how we've approached things in the past, chart an ambitious course to sustainable, profitable growth as a specialty talent solutions provider. Also share some ideas about how we can create more clarity regarding our expectations for tracking the financial outcomes of that growth as these plans are underway. Before we dive in, Olivier will take a moment to cover the safe harbor language.
Good morning, everyone. Let me remind you that any comments made during this call, including the Q&A, may include forward-looking statements about our expectations for future performance. Actual results differ materially from those suggested by our comments, and we have no obligation to update the statements made on this call. Please refer to our SEC filings for a description of the risk factors that could influence the company's actual future performance. In addition, during the call, certain data will be discussed on a reported and on an adjusted basis. Discussion of items on an adjusted basis are non-financial measures designed to give insight into certain trends in our operations. And finally, please note that year-over-year comparisons are represented in nominal currency, except our international staffing segment, which is in constant currency. We have also provided more information on our performance in the fourth quarter slide deck, which is available on our website.
Thanks, Olivier. So look at Q4 at a high level. We saw a continuation of many of the dynamics evident in Q3. We continued to effectively manage costs, and we saw better than expected improvements in our gross profit rate due to ongoing structural shifts in our product mix, particularly in our GTS segment. These positives were outweighed by declines in our staffing business, most notably in our U.S. commercial operations. Like Q3, these declines were the disruption from our Q1 restructuring, continued weakness in the U.S. manufacturing sector, historically tight labor markets, and some planned exits from several high-volume, low-value accounts. And in our international operations, economic headwinds in Europe continued to constrain top-line growth there. I look forward to sharing the recent steps we've taken to respond to the current situation, including how we're promoting growth while continuing to reap the benefits of our lean, agile operations. These recent actions lay the groundwork for a strategy that includes a more aggressive inorganic growth plan, increased focus on talent, and greater urgency to building specialty growth platforms that will deliver results for clients, talent, and shareholders. I'll share more details about these changes in a few minutes, but first, Olivier is going to take a closer look at Kelly's overall performance for the fourth quarter and the full year.
Thanks, Peter. Just to provide it more color, as a result of the dynamics that Peter just mentioned, our Q4 results didn't meet all of the expectations we laid out as part of the outlook in our last call. Our Q4 year-over-year revenue was down 5.4% versus a 4 to 5% decline in our outlook. Our GP rate exceeded our expectations, up 30 basis points compared to expectation of a flat year-over-year GP rate, and expenses, while down 2%, were shy of our expected 4 to 5% year-over-year reduction. Now, I will review our year-over-year performance in more detail. Revenue totaled $1.3 billion, down 5.4% from the fourth quarter of the prior year. Our total company reported results were unfavorably hit by 20 basis points due to foreign exchange. Our Q4 performance includes the results of NextGen and GTA, which added 210 basis points to our constant currency revenue growth. So, on a constant currency and organic basis, our revenue for the fourth quarter was down 7.3%. Overall, the Q4 constant currency organic revenue trend declines in all three segments. Looking at each segment on a reported basis, the Americas staffing revenue decline is primarily due to the light industrial and office clerical products, or the commercial portion of the business, which was down 19% year-over-year. The decline was partially offset by the KELYA education practice, which was up 5% in the fourth quarter and reflects a revenue growth. The international staffing revenue decline reflects a continuation of the challenging market conditions in Europe. And finally, GTS returned to revenue growth, up 2% year-over-year, but down slightly on an organic basis. The growth comes with structural improvement in our product mix, with outcome-based services like business process outsourcing and Kelly Connect continuing. The GTS revenue growth rate was moderated by declines in payroll process outsourcing and centrally delivered staffing. Permanent placement fees were down 18% year-over-year from continued fee declines in Americas staffing and international staffing. Overall gross profit was down 3.7%. Our gross profit rate was 18.3%, up 30 basis points when compared to the fourth quarter of the prior year. Approximately 20 basis points of the GP rate improvement was driven by the acquisition of NextGen and GTA, which are higher margin specialty businesses. On an organic basis, the GP rate improved by 10 basis points as improved customer and product mix was offset by the impact of lower perm fees. And expenses were down 2.3% year-over-year, or down 5% on an organic basis. The decline in expenses reflects our ongoing cost management efforts in response to our top-line trends. The largest reductions in expenses came from Americas staffing, where expenses were lower, primarily due to lower incentive-based compensation expense, as well as lower salaries, result of our Q1 restructuring actions, and international staffing, where expenses declined in line with revenue. In the fourth quarter results include a $15.8 million impairment charge related to our U.S. front office technology development project. During the quarter, we determined that we would not complete this project, for which we have capitalized certain development costs, and we saw an opportunity to immediately move forward with enhancements to a technology platform that is already deployed in parts of our business. We'll complete the rollout of this technology to most of our frontline staff in the U.S. and Canada by mid-2020. This approach will accelerate our solution implementation and the recognition of the related business benefits, including productivity improvements and an improved experience for both our employees and the talent we connect to work. Earnings from operations were $13.1 million in the fourth quarter. Excluding the impairment charge, earnings from operations were $28.9 million, compared with 2018 earnings of $33.1 million. Excluding the impairment charge, the overall decline is 13% year-over-year in Q. The largest driver of the decline is the Americas staffing segment, where revenue declines led to lower year-over-year earnings from operations, despite of an improving GP rate and good expense management. International staffing was able to deliver year-over-year earnings growth in the face of challenging market conditions and lower revenue. And finally, GTS delivered another quarter of year-over-year earnings growth. Our fourth quarter results, excluding the impairment charge, reflect a conversion rate or return on gross profit of 11.8%, down 120 basis points compared to Q4 2018. On a full-year basis, earnings from operations, as reported, was $81.8 million compared to $87.4 million in 2018. Except Q1 restructuring charge, the Q2 gain on sale of vacant land, and the Q4 impairment charge, 2019 earnings from operation was $90.6 million compared to $87.4 million, up 4%. Our 2019 results reflect the headwinds of declining organic revenues, partially offset by the results of our NextGen and GTA acquisitions. We continued to focus on improving our GP rate, both organically with structural product mix changes and inorganically through the acquisition of higher margin specialty businesses, and on executing solid expense control. Putting it all together, earnings from operation and conversion rate, including the result of our recent acquisitions, continue to improve on a full-year basis. Kelly's earnings before tax also include the unrealized and losses on our equity investment in Persol Holdings. For the quarter, we recognized a $700,000 pre-tax gain on our Persol common stock compared to an $83.2 million loss in the prior year. For the full year, the gain is $35.8 million compared to a loss on Persol stock of $96.2 million in 2018. These non-cash gains are recognized below earnings from operations as a separate line item. Income tax benefit for the fourth quarter was $5.9 million compared with our 2018 income tax benefit of $23.8 million. Q4 2018 income tax benefit includes $25.4 million related to the non-cash tax benefit on the loss on Persol stock. And finally, reported earnings per share for the fourth quarter of 2019 was 43 cents per share compared to a loss of 62 cents per share in 2018. In order to better understand the underlying trends in earnings, let me provide you some additional information. 2019 earnings per share was unfavorably impacted by the impairment charge, partially offset by the favorable impact of a gain on Persol stock net of tax. In 2018, EPS was negatively impacted by a loss on Persol stock. Adjusting for these items and including the results of the recent acquisition, Q4 EPS was 71 cents compared to 87 cents per share in Q4 2018. And for the full year, reported diluted earnings per share were $2.84 compared to 58 cents for 2018. Full year earnings per share for 2019 were impacted by the gain on sale of assets and the impairment, as well as restructuring charges. Gains and losses on Persol common stock impacted both years. Adjusting for these items and including the results of the 2019 acquisitions, diluted earnings per share were $2.38 in 2019 compared to $2.27 in 2018, a 5% increase. Now, moving to the balance sheet. Cash totaled $26 million compared to $35 million a year ago. Debt was $2 million, consistent with year-end 2018. Accounts receivable was $1.3 billion and decreased 1% year-over-year. Global DSO was 58 days, an increase of 3 days over year-end 2018. The increase in reflects both increasing pressure from our global customers and the timing of customer payments at year-end. In our cash flow for the full year, we generated $82 million of free cash flow compared to $36 million of free cash flow in 2018. With our improved level of free cash flow generation, we paid down the debt used to fund the $86 million acquisitions of NextGen and GTA. This achievement gives us added confidence as we accelerate the inorganic component of our specialty talent strategy, including the early 2020 acquisition of Insight, which we announced last month. Insight is a provider of K-12 education staffing in complementary markets to our existing education business in the U.S., and cash paid at closing was $38 million. The purchase will start to be reflected in our Q1 2020 financial results.
Thanks, Olivier. I'd like to turn to our near-term priorities and what we've accomplished since I became CEO. I'll start with our top operational priority, growth. When we restructured our U.S. operations last year, we had two primary goals, to drive efficiency and to drive growth. We are pleased with our progress with efficiency. In fact, we're ahead of plans. We have not yet delivered on our top-line growth expectations, and I've made returning to growth a top priority during my first 120 days, and we're instituting aggressive changes to get us there. We're reallocating sales and marketing resources to drive increased demand, and we're seeing positive momentum in our pipeline. We're centralizing support functions to allow our front lines to have greater focus on sales and recruiting, a move that should provide growth as well as expense savings. We are rolling out new front office technology that improve our recruiters' effectiveness and make it easier for talent to work with us through a modern tech-enabled process. This rollout will give our commercial and education teams new front office technology for the first time in almost 20 years and resolves uncertainty about front office implementation timing and delivery. We are using centralized recruiting to support certain large customers, and we're already seeing improvements in fill rates. The centralized model has the added benefit of allowing recruiters to focus on higher margin business. And we are accelerating our shift to a more responsive tech-enabled delivery model that allows us to target resources to the fastest growing markets and aligns with the preferences of the modern workforce and customers across the U.S. While returning to growth has been and will continue to be our top priority, we are acting with urgency to take care of business elsewhere in the company. In December, we announced plans to sell our HQ and lease back our main building, bringing employees together in 2 locations. This arrangement enables our progressive work-from-anywhere HQ program and reinforces Kelly's intense focus on growth by freeing up capital for investments that accelerate our specialty strategy. As Olivier mentioned, we made one of those investments early this year. Our purchase of Insight, a fast-growing provider of education solutions, advances our specialty strategy and further strengthens Kelly Education's leading position in the U.S. market. It's an exciting addition to our high-performing education growth platform, and we're thrilled to have Insight's operational founders join the Kelly Education team. I also announced the appointment of Kelly's first-ever Chief Growth Officer to place even greater emphasis on our growth mandate. Among other responsibilities, this role will ensure that we're allocating the right people, process, and technology resources to achieve our growth within and across our specialties, accelerate our inorganic growth plans, ramp up our use of innovation and market research to identify new growth platforms, and ensure Kelly's pricing and channel development strategies align with our goals for growth. And finally, we have made excellent progress in establishing an operating model that optimizes Kelly's structure, capabilities, governance, accountability, and ways of working. These steps taken over the last are addressing the need to stabilize our U.S. operations, accelerate growth, effectively manage costs, and drive further specialization. With these actions behind us, let's have Olivier walk us through our outlook for the year ahead.
Thanks, Peter. Please note that the outlook for 2020 does include the impact of the recently announced acquisition of Insight. For the full year, we expect our reported revenue growth to be 3 to 4%, and we expect the impact of FX on revenue to be significant. We currently expect Insight to contribute approximately 100 basis points to our revenue growth rate. We do anticipate that our organic revenue growth will improve progressively during the year, but Q1 revenues are likely to reflect a year-over-year decline due to the growth challenges we still face in America staffing. We expect that this pace of growth will be supported by the initiatives that Peter laid out for the Americas. We expect the gross profit rate to be up slightly on a year-over-year basis. While we may continue to experience some volatility in the GP rate on a quarterly basis, as we have seen in the past, structural changes in business mix from our shift to higher margin specialty solutions are expected to positively impact our GP rate for the full year. We anticipate expenses to be up 2 to 3% on a reported basis. This includes increases in incentive compensation expenses, which will only be paid upon achievement of performance objectives, continued spending on technology, and the impact of our recent acquisition. We also expect that the modernization and efficiency actions discussed today will provide cost savings. We have included an estimate of the cost savings outlook while excluding the expected one-time cost of such actions. We'll share the details of both the cost savings and the one-time costs during our next update. So all in, we'll continue to make investments in several key areas of our business in 2020, and we expect to deliver year-over-year improvement in our conversion rate. Consistent with our prior discussions, the outlook provided does not reflect gains and losses on Persol stock, although we do believe that future unrealized gains and losses resulting from changes in market price could be material. The outlook also excludes the impact of our recently announced agreement to sell and lease back our corporate campus, including the expected gain on sale. The proceeds of the sale are expected to be approximately $51 million net of tax and transaction expenses, and will unlock capital to invest in our specialty growth platforms. And finally, our 2020 annual income tax rate is expected to be in the low to mid-teens range. This does include the impact of the Work Opportunity Tax Credit, which was reinstated for 2020. I'll now turn it back over to Peter for his concluding thoughts.
Thanks, Olivier. It should be clear that we're acting with urgency to deliver progress in 2020. At the same time, we're looking further down the road to a day when the full potential of KELYA is realized. We have a lot to build on. We have one of the best brands in the industry. We have a solid balance sheet fortified over many years. We have an exceptional blue-chip client base. We put to work thousands upon thousands of people looking for what's next in their work-life journey. And importantly, we have the most dedicated employees anywhere. Our long-term goal is to unlock the potential of these valuable assets by deploying them differently, enabling them with technology differently, and supporting them with an operating model differently than we have in the past. Over the course of 2020, I will have much more to share about how we will do this and the changes we will make, some of which, frankly, are overdue. For today, there are 3 significant changes that I want to share with you. First, we intend to accelerate our efforts to drive our top and bottom line performance through acquisition of inorganic growth platforms, making smart buys that align with KELYA's focus on specialization. Here's why I'm confident in this organic growth strategy and why it has the full support of KELYA's board of directors. We have the benefit of a rock-solid balance sheet with ample financing capabilities under terms which reflect that strength, and were just renewed in December this year. We have a strong track record of improving our free cash flow generation. We have proven our ability to quickly and efficiently integrate new acquisitions that deliver meaningful growth for KELYA. And we have shown that we can finance these acquisitions and deleverage quickly. In fact, we have no debt remaining for many of our acquisitions. Our future capital allocation will be focused entirely on growth, both organic and inorganic, in our chosen cities. The second change stems from the fact that our growth plans are ambitious. and I don't believe achieving this kind of growth will happen within Kelly's current structure, which is too complex to enable our specialty talent strategy. Today, I'm announcing an important change designed to intensify Kelly's focus and accelerate our growth. We have proven that in areas where we specialize in line with demand, we perform well, and we have made clear growth is tied to our success as a specialty talent solutions provider. Moving forward, we will combine our assets and resources in 5 business units, each defined by clear strategies and measurable targets that will inform our M&A strategy and guide how we allocate our resources. The new structure will include these 5 specialties: commercial, which we are renaming professional and industrial; education; STEM, which includes science, IT, and engineering solutions; OCG; and international. Each specialty will be led by a business unit president reporting to me, who will be laser-focused on driving growth within their specialty. The 5 leaders will work with our new Chief Growth Officer, who will identify growth opportunities across the business units, help maximize efficient support systems, and drive profitable collaboration. Together, this leadership team will move specialty growth strategy forward in a meaningful and measurable way, taking responsibility for both organic and inorganic opportunities while meeting customers' needs for talent and connecting talent with great opportunities, all at a more accelerated pace. We expect this new way of working will allow us to allocate our corporate functions to be just as focused on growth as our operations are. We'll be transitioning into the new structure over the next few quarters, as well as roll refreshed logos that signal Kelly's specialty focus. Finally, the third change is a commitment to bringing new transparency to our goals for growth. I'm pleased to share what we're calling a growth map that outlines the goals we're aiming to hit for 3 specific financial areas. Here's what we'll be tracking: revenue growth, including parameters for both organic and inorganic growth as we execute our more acquisitive plans. Gross profit margin we see as the appropriate measure of progress on our journey toward higher value specialization. And EBITDA margin, an update to our previous conversion rate measure as we fix our sights on more inorganic growth platforms. We will be sharing more details about our growth map next week after we present at the Noble Capital Investor Conference. You'll be able to view a webcast of our presentation and access all supporting materials on our investor website. Starting later this year, we will begin reporting on these metrics and our goals to help gauge our progress. We will be refreshing these goals regularly so that you have line of sight to the next period on a rolling basis. We hope you'll see this added transparency as a valuable and positive change from our past practices. I'm excited about what's next for Kelly. The last 120 days set a new stage and pace for growth. Our new operating model is designed to accelerate specialty growth and profitability by playing to our strengths and focusing on specialties that align with market needs. The acquisitions we've made in the last 3 years are just the start of an ambitious program to use inorganic growth to drive our financial performance. We're addressing key structural issues and modernizing our operations to adapt our infrastructure and take advantage of the latest technology. We understand talent and are becoming more agile to meet them and our customers where they are. And we're doing it all while creating a more fulfilling experience for the customers and talent we have the privilege to connect. Putting Kelly onto a higher growth trajectory isn't going to happen overnight, but I believe we are already laying the foundation and moving ahead with a renewed sense of urgency and purpose to realize the full potential of our great company. We look forward to reporting the results of our efforts each quarter as Kelly's transformation unfolds. Meantime, Olivier and I will be happy to answer your questions. Cynthia, the call can now be open for questions.
Thank you. And ladies and gentlemen, if you wish to ask a question, please press 1 and then 0 on your touch-tone phone. You will hear a tone indicating that you have been placed in queue. You may remove yourself from queue by pressing that same 1-0 command. Once again, for any questions or comments, press 1 and then 0 on your touch phone. And one moment, please. And our Our first question will come from the line of Josh Vogel with Sidoti. Your line is open.
Thank you. Good morning, Peter and Olivier. How are you guys?
Good morning, Josh. We're good. How are you?
I'm great, thank you. I got a couple questions. I guess the first one, just about one of your initiatives here. I'm assuming that you already have the president of each specialty in place, or is this something you're going to be looking to add?
We'll be announcing the presidents, Josh. So yes, but we'll be announcing them probably in the next by the end of the quarter.
Okay, great. And then with the announcement, I think it was last week, of Tim Dupree as your CEO. Do you feel that you have your executive team rounded out?
Yes, I would say that with the BU presidents and the current leadership team, including Tim, we have a complement of leaders that are ready to deliver on our strategy. That's not to say that we won't add talent where it's necessary, but I think we're ready to deliver on this plan as I've laid it out.
Okay, great. Look, with your outlook for 2020 and all these initiatives and strategies in place, I was pretty surprised, but certainly encouraged by your full-year revenue growth guidance. Understanding Q1 will be down year over year, and there's the 100 basis point contribution from Insight. But what gives you the confidence you could put up mid-single-digit gains later this year? And could you maybe this is more for Olivier, kind of give us just like a sense of, I know there'll be progressive improvements throughout the year, but if you could just give any more insight or details on how you see revenue trajectory playing out this year.
Yeah, I mean, as we did mention, we believe that Q1 is going to be still challenging on organic basis because of what is going on in our U.S. operations commercial. But I think we have a solid plan in place, and we start to see some progress, naming one of them, the pipeline. And we feel that we are going to start to see some traction that would enable us to show still a little bit of a challenging Q1, but some improvement in our overall organic growth trajectory with improvement or further improvement as we move to the remainder of the year. I think the other thing is our recent acquisition, NextGen and GTA. When you look at what we did achieve in 2019, it's a growth platform that did grow at about 22% top line, providing a very interesting value profile at 27% margin and very good bottom line. The two acquisitions were already accretive as soon as Q1 of 2019 and generating 22 cents of EPS for the full year. We see and continue to see good traction in our education business. You have seen that we did mention a return to growth from -1 in Q3 to +5 in Q4, and we see further traction as we enter into 2020. We see good traction also outcome-based business as we have seen in 2019. So there are a lot of, I would say, dynamics that are in play that give us confidence that especially if we continue to make progress on our U.S. operation commercial staffing, we should progressively improve our organic capabilities during the year. And again, we plan to have about 100 basis points of extra boost on our organic growth coming from Insight, which is an excellent geographic complement to our existing K-12 substitute teacher business in the U.S.
That's really helpful. Thank you. And I'm sorry, did you say that NextGen and GTA grew 22% last year versus their 2018 numbers?
That is correct. And you will see that in details when you have access to the 10K, because we have an analysis that is showing basically the progress, and through our earnings release 8K, where we show some analysis about that as well.
Okay, wonderful, wonderful. Focusing on your inorganic strategy, can you just talk a little bit about the pipeline of opportunities you're seeing today, knowing that you can't discuss any future or potential deals, but just curious what the pipeline looks like and from a specialty perspective.
Yeah, a couple of comments, Josh. I think because we have, as compared to past periods, been more acquisitive in the last few years, relatively speaking, we have been included on a number of transactions that we may not have been, in prior periods. So we're encouraged by the fact that we're being seen a company that is playing in the M&A space more aggressively, and I think with today's my laying out our plan for the future, we would expect that to continue. We are developing not only a reactive pipeline strategy, but also a proactive pipeline strategy where we're identifying growth platforms that exist within KELY or we think would be complements to growth platforms in KELY, and using a variety of resources to try to generate additional targets for acquisition, and I would say that is a work in process, but it's clearly more robust than it has been in the past.
Okay, great. And just one last one, and I'll hop back in the queue. It was a nice way to unlock capital through the headquarters sale and leaseback. I guess it's just a quick two-parter. How much? Can you remind me how much you have available on your current facility? And then just also, you still have these attractive assets on the books related to Purcell, and I personally feel that the street doesn't seem to give enough attention to that. I'm just curious, is there any plan to potentially monetize or liquidate a portion of those investments and put that work elsewhere?
Yeah, I'm going to start, and Peter is going to complement, especially when it comes to commenting on our JV APAC assets, as well as our shares with Purcell. So we have renewed our financing capabilities in December of last year. So the overall capacity is $300 million. $150 million through a securitization program, and the rest with a traditional revolver. We feel, as Peter mentioned, that we have ample capacities basically to execute and accelerate on our inorganic initiatives. We did mention today that basically our balance sheet at the end of 2019 is completely or almost deleveraged. Our debt is so we feel comfortable now with our significant improvement in free cash flow generation that we can use this $450 million capacity whilst making sure that we can deleverage with our free cash flow, which is, of course, very important, especially for a cyclical industry like our industry.
Yeah, Josh, and with respect to other assets of the company, we're regularly evaluating how best to combine resources and how to, consider resources to create value. And, there isn't any asset or resource that's off the table in that regard, but we have nothing to announce with respect to any specific asset other than the ones we've mentioned today. So, it's a regular part of our review of how we're allocating resources and how we're using our capital to drive growth.
Well, thank you guys for taking my questions. Looking forward to see and watching 2020 play out.
Yeah, thanks, Josh. Really appreciate it.
Thanks, Josh.
Thank you. Next, we'll go to the line of Joe Gomes with Noble Capital. Your line is open.
Good morning, and thanks for taking the question.
Joe.
Good morning.
So I just wanted to circle back about the outlook for 2020, and understand, what some of the the next gen and the education returning to growth. But a lot of this, if you look at relatively large decline in the U.S. staffing business in the fourth quarter, and some of the issues you outlined today and in previous calls, what gives you confidence that U.S. commercial business is going to stabilize in the near term?
Yeah, thanks, Joe. What gives us confidence is that the initiatives that I've instituted since becoming CEO are, in large measure, beginning to show results. And I think, as Olivier mentioned, we believe that the U.S. commercial is stabilized. We clearly have work to do on returning to growth, but the initiatives that we've instituted, including reallocating resources to drive demand, acting on our shared services and centralized delivery models to a greater focus on higher margin business. We like what we see. We're not comfortable with the results or pleased with the results because we have to get back to growth. But when we look at the pipeline and some other things, we see signs that the initiatives we've taken are beginning to take hold.
Okay, thanks for that. And if you could provide a little more color or detail on the technology development project and why you guys stopped and took the charge there. I mean, a little more insight into that would be appreciated.
Yeah, we about two years and a half ago, we did start an initiative on the front and middle office for our U.S. business to replace basically an old in-house developed ERP that was 20 plus years old. We have realized that as recently as Q4 that there were some uncertainties on when we can get this new front and middle office being delivered. And we saw an opportunity basically to move with something else that we're familiar with because we are using the system we are now implementing or expanding. We have used it over time. So we saw that with the uncertainty around the timing of the delivery combined with the risk of coupling front and middle office, we had an opportunity to really accelerate the delivery of this new platform. As we speak, we have already implemented this new system for 200 people. So that was basically the trade-off. I mean, getting the pain of, I would say, the asset impairment of $15.8 million in exchange with we can get something now as we speak and implement quickly, enhance the system to get similar benefits than what we're expecting with our initiative. And we expect as soon as the second half of 2020 get additional productivity and other metrics being enhanced and improved through this system. So the trade-off was really the pain of, this asset impairment versus making sure we get the benefit of this new system as quickly as possible, which is what we see now. I mean, again, we have implemented already the system to shy of 300 people. By mid of 2020, we fully in place. And we are going to start to see basically what benefits we're expecting post-implementation, as opposed to significant uncertainty with the first option on when we are going to be able to deliver on this project.
And Joe, okay. I would just add, relative to your question about confidence for the back half of the year in growth, that we're introducing new technology, as I mentioned, for the first time in almost 20 years, and we believe that our U.S. commercial teams will be a significant beneficiary of this modern, latest technology in their recruiting.
Okay. And then if you could just provide a little color on what you guys see, in the European market, in 2020. What's going on there? Where do you see, some positives? Where do you see some challenges?
Well, it's a tough call because there are so many disparate economic issues in the region. There continues to be uncertainty regarding Brexit, or as a result of the Brexit outcome. There are challenges, economic headwinds throughout the region. Although, and I'll ask Olivier to comment as well, but I think there are some, at least signs that the deterioration is not accelerating, and there are pockets of growth and pockets of development that we expect to benefit from. But we're not such a huge player in the region that we're going to be a bellwether of what's going on there. But we do expect the sort of current state to be what we should expect for 2020.
Yeah, I would just add on that our life science specialty is still doing well, where we are specialized on this area. Eastern Europe, specifically Russia, we are still seeing some traction like we have seen in 2019. We are going to continue to run the business in a meaningful way, manage our resources, making sure that we continue to stabilize our margin as we did along 2019, but we don't expect top line, being very dynamic. I think it's going to be kind of similar to what we have seen in 2019, but with no sign of further downside, I would say. And whenever there are pockets of opportunities, and we see a lot of them sometime in many countries in some very specific specialties, we are usually good at capturing them very quickly and get some benefits. But the overall environment is, I would say, not very favorable, but not going down further.
Okay, great. Thank you very much.
Thank you.
Thank you, Joe.
Thank you. Next, we will go to the line of John Healy with North Coast Research. Your line is open.
Thank you. Peter, just want to get a little bit more thoughts just about the future M&A strategy and how it may be deployed. Is there a way you could kind of help us conceptualize maybe the amount of capital that you and the board have kind of earmarked for potential M&A? And additionally, will it be mostly domestic oriented as you try to get more targeted within certain verticals, or do you think the international M&A will also be an element to the toolkit?
Yeah, thanks, John. So, without giving specifics, I would say that, if you consider the $150 plus million that we've spent in the past 3 years, that when I talk about a acceleration and a more ambitious M&A plan, it is probably reasonable to think about it as a multiple of that. And as we go forward, we'll do our best to try to frame it for you in more specific terms. But I think right now that's probably how I would think about the quantification of it. And in terms of the that we're focused on, I would think that we will clearly be overweighted in North America versus our international operations. It's not to say that we would preclude if there was something opportunistic, but we see huge opportunity in North America. It's the largest staffing market in the world. We see significant opportunities in outcome-based. Our outcome organic platforms are growing nicely. So complementing those areas here, we think is probably where our capital is best allocated.
Great. And just trying to get a little bit more detail 2020 seems like it's a year of a lot of unknowns in terms of where the industry is headed, especially with the election, later this fall. Does that make you kind of pause your M&A pursuit this year and make 2020 kind of a due diligence year and 2021 maybe a year of action because maybe you're able to get prices that are very different? Or do you think that you'll be active in terms of closing transactions in 2020?
Well, John, it's a great question. We're very aware of where we are in the cycle, and so we're going to be, diligent about making smart acquisitions if we're going to make acquisitions. But, we think that there are opportunities to pick your targets even in this, this year, recognizing, as I said, that we're not going to overpay for properties or, get into markets that we're not comfortable are long-term growth platforms.
Yeah, just to add on that, next week, Peter mentioned that we are going to be participating to a Noble Capital event, and we are going to share more details about our acceleration in terms of capital allocation strategy.
Great. And then just one final question for me. On the balance sheet, it looks like there's a property held for sale of $21 million. Is that related to the headquarters, or is there something else that is kind of in transaction?
That's correct. That's basically the headquarters that we have mentioned. It's roughly $21 million. I did mention that the net proceed, net of tax and transaction costs, is going to be around $51 million. So basically, we are going to recognize in Q1, because we are going to secure the deal in Q1, a $30 million capital gain, and meaning the $51 million net of tax and transaction costs will happen before the end of Q1.
Great. Thank you, guys.
Thank you.
Thank you.
Thank you. And as a final reminder, for any other questions or comments, press 1 and then 0 on your touch-tone phone. Once again, for any questions or comments, press 1 and then 0. And allowing a few moments, I'm showing no further questions in queue. Please continue.
Okay, Cynthia. Thank you very much.
Thank you very much.
Thank you. And ladies and gentlemen, that does conclude your conference call for today. Thank you for your participation and for using AT&T Executive Teleconference Service. You may now disconnect.